I said I wanted to talk to you about how people choose when to buy and when to sell uh, in the foreign exchange market. And I mentioned in a previous video fundamentals. Well, I want to talk about technicals. Now, again, this is a relatively basic introduction how they do that. And with technicals, we often will look at things which have nothing to do with the macroeconomic side. And these are my favorite way of looking at the markets. And the reason for that is, as you can imagine, macroeconomics and looking at interest rates and trying to second guess all of that's very difficult. Whereas looking at technicals or charts makes life a lot easier. And I'll show you how we get price charts. But imagine this is a currency chart where it might be sterling against the dollar or euro against dollar, anything else. We'll often look for trends, upward trends, which says to us buy low and you'll be able to sell high, or similarly sell high and you can buy low. Has the same problem. That's called shorting, and when you short you make profits, of course, and when you go long, which is buying low and selling high, you make profits. Or you might say, well, I'll do in a sideways market, I'll stay out of it because obviously I'm not going to make money, it's just going sideways, or I'll try and time it so that I make profit on the way down, a profit on the way up, and so on. So that generally, in essence, is what we're looking for when we're looking at charts. And the point here is we now need to finesse that to understand charts better so that we know when we should buy, when we should sell more precisely. But in broad terms, very often we are looking for price trends. Going upwards or going downwards. If they're going upwards, we go long, we buy low, sell high. And if they're going down, it's called going short, which means you sell high and buy low. You do it in reverse. Sounds a little bit complicated, but don't worry. There'll be lots of examples in the other videos of what I'm talking about. This is just introductory. Another popular, very simple, straightforward strategy is to look at what's called moving averages. Now, a moving average is the average of what the price has been, let's say over the past 10 days or over the last 50 days, over the last 200 days. The reason it's called a moving average is because, of course, as the price changes every period, then so does the average of the last 10 days, because obviously it's the most recent 10 days, and every day, for instance, or every 10 minutes, or whatever the time frame you've set your computer at and you're looking at, changes. So it becomes a moving average. Now, here you can see in blue the 200-day moving average. And very often one simple strategy used by traders is they will go long. In other words, they'll buy and hold as long as the foreign exchange rate is above the 200-day moving average. And others will do something which is a little bit similar to that, which is they will take as a buy signal when the shorter term moving average, for instance the 50-day moving average, moves through the 200-day moving average. So when there's a crossover, or as you can see here, when there was a crossover between there you see the crossover between the longer and the shorter term moving averages. Now they take that as a buy signal on the basis that if the price is above that, then the price is in a strong uptrend. Now moving averages, as you will see later on, are not necessarily the most accurate, but they often do work very often. There's something of what we call a lagging indicator. A lagging indicator means one which can be a little bit late in telling us which way the market's going to move. And here you see the 50-day, which is the lighter brown one, and you see the 10-day, which is the darker. So the buy signal here was when the 10-day crossed through the 50-day. In other words, when the short term crosses over the long term, is one way people look at it. And what they say is when that happens, it means it's in a short term upward trend, and for as long as that happens, we should be long the currency, be buying and holding it. So as I say, a relatively straightforward and simple technique there. Now I mentioned the strategies. earlier, and I said that there are fundamentals. Let me just return for a second fundamentals. Of course, with the technicals and the chart-based ones, I'll take you through more of those in the videos and go into far more detail of how we pick when to buy and when to sell based on trends and knowing the precise moments. But for the moment, let me just remind you what I said earlier about the simple strategies to do with things like the news. Very short-term strategy people will often use where they want to look at fundamentals, not charts, but they don't want to be looking at all the fundamentals. What they'll do is they'll wait for a specific piece of news. For instance, the Federal Open Market Committee, and I'll tell you how you know which pieces of news are important and where you get them from in a second, said late yesterday that strains in global financial markets have eased and the labour market is gathering strength. At the same time, it said that the unemployment rate is elevated and significant downside risks remain. They plan on holding the interest rate. Okay, so that's a piece of news that comes out. What very often people will do is they won't try to interpret that news, whether it means good or bad things. Here we're looking at the euro dollar, so 1 euro equals this many dollars. Yeah. So what they'll do is they'll wait for that federal statement. And as I said, I'll tell you where we get that from and also where we find free software to get this kind of charts in other videos. And they'll wait to see which way it goes. And then they'll say, right, the market, it's come out, the news has come out, the market's tended to move down, so I'm going to remain, for the forthcoming moments, I'm going to remain bearish. Now you can see there's extreme volatility, of course, the market goes up and then moves down. So it is a risky strategy because you may be fooled into thinking that, it's not going your direction. That's the risk. But what here we're doing is we're sort of using fundamentals and technicals in that we're looking at the price chart, we're using the fundamentals to see which way the market moves, and then once it's moved in that direction, we follow it lower ourselves. Another example is UK jobs data. Now here we're looking at sterling dollar. So £1 buys this many dollars, and you can see it fluctuating. We wait for the UK jobs data. We see that the price has moved lower as soon as the data has come out, and so we too sell high in the expectation of buying back cheaper later. So we don't try to interpret UK jobs data, we let the price move afterwards. And as the prices move low, we say, okay, that means that we should also move lower and expect it to move lower. Where do we get data? Well, there's ample websites on the internet which will tell you the timing of important data and which country it relates to, and therefore which currency you should look at, and it will tell you its importance and the volatility it's likely to result in, because some, of course, data won't matter much, others will be very important. Jobs data tends to be very important. How do you know what data is important? Well, websites will tell you. How do you know which way the market's going to go? Well, you let the market move. You don't have to interpret that weak UK jobs data meant that people expect that the UK economy won't be growing so much, people won't have so much money to spend, and therefore interest rates are not likely to rise in order to counter any likely inflation, and therefore they can happily look to sell sterling and buy dollars because sterling isn't going to be paying a lot of high interest in the short term. Now, of course, that's my macroeconomic interpretation. You don't need to do any of that. You wait for the jobs data to come out, you see the price fall, and you go short as well. How do you know what data to look at? As I said, there's lots of websites which will give you that information. I'll detail those in future videos as well. What I mentioned about technicals and technicals for buying and selling. Here's an example. We're moving averages, very short term. You could, as I said earlier, just wait for a crossover of the moving averages, or as you can see here, we've done that with the moving average. You wait for a crossover. As soon as that crossover happens, you just enter, and then you can exit when the crossover reverses, and there's various opportunities to reverse there. Or you can look to say, I will use these resistance lines. So what are resistance lines? Let me explain those to you because they're often used by traders. Resistance line basically is usually a horizontal or near horizontal line. Sometimes it'll be a little bit diagonal, which just joins up price highs, and that becomes resistance. If it joins up price lows, it's called a support, and you can see the price bounces off of support, bang, bang, and because it's a horizontal line, we consider that that has some kind of significance, and therefore when the price goes near, we expect it to go to bounce off it. So if you entered around here at the crossover, let's say, the reason you might put a stop loss, and I'll deal with stop losses in future videos, but is you don't expect the price to go in the opposite direction of your trade. So if you entered here because you expect the price to fall short and go lower, why do you expect that? Well, because the shorter term moving average crossed below the longer term moving average, so that when it happens in that direction, which is the opposite to what we saw before for longs, what happens in that direction, you go short and the market is dropping down here. When that happens, you say, well, okay, that's the direction I expect to go in, but where do I exit in case I'm wrong? That's very important, and I'll mention stop losses, money management later. Where do I place the exit just in case I'm wrong? Well, the place you do that is you often find a nearby resistance, and that's where you place your stop. In other words, a point where the price has not gone above before, and you say, well, if it goes there, it goes above a nearby resistance, that'll be my stop loss. That's the most I can lose. And that's important because now you know the most that you could lose is. Another way in which traders will often look to enter is when the price does break through a resistance. They'll say, look, if it's gone through resistance, especially two lines of resistance as it has here, then that's a good point at which to do a long entry, to enter, especially if they get confirmation from the moving average, the shorter term going through a longer term moving average. Now we could look at any time frame which suits our work schedule. We could look at daily charts if we only want to get very few signals because we're busy at work, or we could just look at 5-minute charts because we're in front of the computer, we've got all the time in the world, and the 5-minute charts will obviously give us different signals to the daily charts, but they all allow the opportunity for profit as a result. So here I've shown you quite a few different strategies. Of course we go into this in far more detail in my other videos, and I explain the strategy about moving averages and resistances and supports in far more detail with pinpoint accuracy as to when you enter. But at the moment I wanted to just give you an overview of how we decide when to buy and when to sell. So just as another reminder and summary again, when do we sell to go short? Well, when the short-term moving average moves below the longer-term one, because that suggests that the price is going to continue moving lower. Where do we place a stop loss so we know our maximum risk at a nearby resistance level? We might also look at entry when the price breaks above a resistance, or for that matter below a support, on the basis it's going to continue moving lower. I'll talk a lot more, as I said, about moving average strategies, other buy and sell strategies, and stop losses as we progress. Just want to give you another example here for the moment. Entry to trade. We saw here target anywhere here because we've got a channel which is a diagonally moving resistance and a diagonally moving lower support. So we entered near the top because we expect it then to fall from the resistance, but we place a stop on the other side of the channel because it shouldn't go through the resistance. If it does, we were wrong. So we're placing an entry expecting the price to go short and go anywhere in this direction. That's a simple buy and sell. Very simple. Every time it goes up here, we're going to go short, and every time it gets near here, we're going to go long, expecting it to go up. Very straightforward trading strategy. What we'll talk about next is some of that issues about stop loss in the next video. But for now, I wanted to just show you how simple these strategies can be just based on supports and resistances, how simple we can set stop losses on the other side of the resistance or the support, and how we can pick our entries where we expect the price to bounce from a support or resistance. Equally, we might say, I'll take the opposite trade. If it breaks through it, then I'll expect it to continue in that direction if it breaks through. But on the whole, we expect it to bounce off a support and off a resistance. That gives us buy and sell points when we're looking at these charts. A very simple, straightforward strategy. I'll go through in future videos more complexities of placing stop losses and so on.